AT&T's stock has fallen dramatically over the past year, primarily due to uncertainty. Last May, they announced a deal to spin off its WarnerMedia business and merge it with Discovery, forming Warner Bros. Discovery. Alongside this, it was announced that there would be a dividend reduction after the deal completes, which would be sometime in the first half of 2022. All this brought a lot of questions. How will the deal be structured? What the companies will look like after? What does this mean for shareholders? What is the future dividend, etc.? All these questions left the stock dead in the water and caused a 25% decline from the announcement of the deal to now. However, as we approached closer to the deal completing, uncertainty started to erode. It bottomed out at $22 a share, and people started to realize it may have been oversold. The two companies potentially offered great value in the market. The stock price rallied 23%, still down significantly, but it seemed as though a turnaround was mounting, especially after the deal completes. Then CEO John Stankey dropped a bomb. Kind of. AT&T just reported its 2021 Q4 earnings and full year results. The actual business fundamentals were all as good as you could want, yet the stock price fell over 8%. Why, you may ask? New uncertainty was introduced. In this video, I'm going to break down the earnings results and then explain exactly what CEO John Stankey said to make the stock fall over 8%. My name is Zach. You should leave a like and subscribe to the channel if you enjoy the video. AT&T's Q4 earnings were very solid. They beat analyst estimates across the board. Revenue came in at $41 billion, which beat analyst estimates by $550 million. GAAP EPS of 69 cents compared to negative $1.95 in the year ago quarter. This number includes investment gains and losses. Adjusted EPS came in at 78 cents compared to 75 cents in the year ago quarter. Free cash flow of $8.7 billion. For the full year, the results were pretty good. Revenues came in at $168.9 billion, down slightly from $171 billion in 2020 due to business divestitures. GAAP EPS of $2.76 compared to negative 75 cents in the prior year. Adjusted EPS of $3.40 compared to $3.18 in the prior year. Total free cash flow of $26.8 billion, down slightly from last year at $27.8 billion, once again due to some of the business divestitures. When looking at all this, it's important to remember that AT&T is not a growth business. It's a reliable cash flow machine. At its current valuation of $172.8 billion, the company is trading at 6.44 times free cash flow. That is a very low multiple. Aside from pure financials, the actual business conditions are doing well. The company reported 884,000 postpaid phone net additions in Q4, making it 3.2 million for the full year. The company said that this was the highest total in more than 10 years. That's great. A low churn rate of 0.85% for Q4, even lower for the full year at 0.76%. 1.3 million total postpaid net adds in Q4, 4.5 million for the full year. Revenue and operating income and mobility are up over 5% with an operating income margin of 25.3%. The company also added 270,000 fiber subscribers in the fourth quarter, bringing them to 1 million net adds for the full year. For WarnerMedia, they hit 73.8 million total HBO Max and HBO subscribers globally. The figure came in above the outlook for 70 to 73 million subscribers that AT&T offered back in September. This is up 13.1 million year over year. The average revenue per user was $11.15, which is actually one of the highest in the industry. Less than Netflix and Hulu, but not that far behind. Way ahead of Disney Plus currently. Let's hear what AT&T CEO John Stankey has to say about the quarter.
More postpaid phone net adds in 2021 than we'd done in the previous 10 years. It was our fourth consecutive year of over 1 million fiber broadband net adds, and we're now increasing the footprint and have an opportunity to ramp that up. And look, at 13.8 million HBO Max adds and what we were able to do to launch on 2 continents and ultimately broaden that product and not only be a subscription-based service, but have advertising support associated with it. Look, it was a home run for the team this year.
I agree. This is very good execution. The communications business is in its best position in years. The streaming business has shown it's a serious player and here to stay. John Stankey argues the media business is being significantly undervalued.
When you look at valuations of kind of where Netflix stands today versus maybe a valuation of the components of AT&T that are represented by media, or when you think about the combined Discovery WarnerMedia, there's a pretty big chasm between those two valuations. And my belief is they've built an incredible franchise, and there is a great business in distribution direct to consumer. You've heard me say it before. I don't think it's going to be a business that there'll be 6 or 7 companies that are successful globally, but just a small handful, and it's a race to see who establishes themselves. I believe in 2021, we clearly indicated that HBO Max and what we're able to do on that platform will be one of those. I'd like to see our valuation actually start to edge up to what Netflix is.
WarnerMedia and the future Warner Bros. Discovery company are definitely being undervalued. Now, I don't think they deserve to trade at the multiple of Netflix, but definitely well above its current state. I also agree that there will be a lot of consolidation in the media space. Of pure media companies, Netflix and Disney are the best positioned, but Warner Bros. Discovery is a strong third. The WarnerMedia and Discovery deal was made with the intention to unlock that value for shareholders. The idea is that AT&T and its media business would be more valuable separate than together.
I made it very clear that we were doing what we thought was the right thing to unlock value for the shareholder for the near and long term. And we understood that there were a lot of moving parts. This is admittedly, to do this and structure it in the right way and avoid things like tax leakage so that all that benefit flows back to the shareholder. There's some moving parts to this deal. And there's some moving parts in restructuring what I would call RemainCo AT&T to make sure that the capital structure is set up properly. I'm not surprised that it went on. Obviously, in my job, I would have preferred that it didn't and that there was a little bit more stability around it. But I do believe what we have set up in the combination of WarnerMedia with Discovery, the RemainCo AT&T and its focus, and the respective capital structures and charters and missions for each of those companies is a very, very compelling value-creating equation. And what I believe we're seeing right now, as you alluded to, as we get closer to the close date, as the uncertainty comes away, as all the questions about whether or not this is going to happen and when it's going to happen, I think we're now seeing investors look at it and say it is compelling.
Spot on. There was a significant amount of uncertainty causing the stock price decline. But as we get closer to the deal closing, that uncertainty has been eroding. However, in this next clip, Stankey gets asked a question that brings new uncertainty to the market. I'll play the clip and then explain exactly what he means and how this impacts my investments in AT&T.
One of the key questions among some of your investors certainly is whether you're going to do it as an exchange offer or a spin, essentially a split or a spin. I know you're not ready to share that decision, but can you at least share some of the thinking behind either one of those? Because they both have their benefits and or potential drawbacks, whether you simply essentially give a percentage share of Discovery, Warner Discovery to each of your shareholders, or actually do an exchange offer whereby you really would end up retiring potentially a good amount of AT&T shares.
Yeah, we kept that option open for good reason because we wanted to assess what the state of the market was as we got closer to the close of the transaction. When we think about going through the dynamics of a split, it's what you said earlier, which is we'd like to possibly over time reduce the AT&T share count, and this may be one way to do that. However, it is a very, very large split. It's unparalleled in terms of anything that's been done ever in history. And, that certainly gives me some pause. And we have a very large retail base in the AT&T stock right now as well. And that retail base sometimes isn't quite as deep in some of these issues as the institutional base is. And so I'm very mindful of the fact that whatever we decide to do, it has to be something that can be clearly communicated so that there isn't confusion in the marketplace and a lot of people carping. One of the things that's guiding us is as we started this, we wanted to do this for shareholder value. Everything we're doing right now is about shareholder value. As you know, to execute a split, especially one of this size, it would require some value leakage to execute that and actually get the shares placed. I'm not sure I'm really a big fan of that value leakage dynamic right now and being second guessed on it. I'm also pretty interested in moving through this as quickly as we can. There's some advantages to doing a spin in terms of how mechanically it can be done and how much quicker it can be done.
In my opinion, this is the statement that caused AT&T's stock to fall over 8%. First, let's explain the difference between a spinoff and a split-off. A spinoff distributes shares of the new company to existing shareholders. It would just show up in your account as a distribution. Simple. This is what the market and I was assuming would happen based on their prior statement that AT&T shareholders will receive stock representing 71% of the new company. A split-off offers shares in the new company to shareholders, but they have to choose between the subsidiary and the parent company. Very different. I've actually never dealt with a split, so I don't even know what it's like from the retail investor perspective. I'm not sure which entity I would choose to own. I want them both. Luckily, it seemed like Stankey was leaning in the direction of a spin-off. In the short term, this is not good news. It brings a new level of uncertainty. In my following of AT&T stock, I've learned about the immense negative power uncertainty can have on a stock price. With all that said, this uncertainty can lead to a long-term buying opportunity. Nothing has fundamentally changed about the business. So what am I going to do? I'm going to reinvest my dividends on February 1st to acquire more shares of the company at a great price. Beyond that, I may buy more shares if the stock continues to decline. Thank you for watching Dividend Data. I'd greatly appreciate if you could leave a like and subscribe to the channel. You can support the channel over on Patreon, where you can gain access to a community Discord server. The link is in the description. Please leave a comment below, and thank you for watching.